Most people think the Federal Reserve is still steering the machine. It is not steering. It is pinned inside it. That is the first thing I want you to understand, not tomorrow, not after the next press conference. Now, because once a central bank stops choosing between good and bad and starts choosing between bad and worse, the entire meaning of a rate decision changes. A hold is no longer calm, a cut is no longer rescue, a hike is no longer discipline. Each move becomes a confession about which part of the structure, the institution, is most afraid to break first. That is the real story here. Not the headline, not the target range, not the performance at the podium. The real story is that the Federal Reserve is trapped between oil, inflation, debt, and politics. And gold has already begun pricing the trap more honestly than the Fed is able to describe it. That is the mother line for everything I am about to tell you. The moment a central bank can neither cut nor hike without worsening a different crisis, the market stops watching policy for solutions and starts watching hard assets for truth. That is the line rated again, because once you understand it, you stop asking whether the Fed did the right thing. You start asking what kind of system creates a world in which no available move is clean, every move damages something important, and the one asset with no central banker attached to it begins acting as the scoreboard. That is a much better question, a much more expensive question if you miss it. I have spent my life watching markets make one mistake over and over again. They confuse language with room to maneuver. A chairman speaks calmly. Investors assume the institution still has options. A statement sounds balanced. Investors assume balance still exists. The central bank says it is monitoring data. Investors assume data still leads policy. Not always. Sometimes the data is only documenting a trap that policy can no longer escape. That is the phase we are entering now. And if you do not understand what that means, you will misread everything that follows. You will misread gold. You will misread bonds. You will misread silver. You will misread cash. You will misread the future of every dollar. Denominated promise you still think is safe because it looked respectable in the old regime. That is why I am being direct. Because old language in a new regime is one of the most expensive forms of self-deception in finance. Now let me show you the first mechanism, I call it, the monetary cage. The monetary cage is what happens when a central bank still appears powerful from the outside, but from the inside, every possible move now intensifies a different problem, already burning in the system. Definition is simple. Cut and you feed inflation, hold and you deepen slowdown, hike and you increase the pressure on a debt structure already too large to carry cleanly. That is the cage. And if you think that sounds abstract, let me make it plain. Inflation is not dead enough to justify comfort. Growth is not strong enough to justify toughness. Debt is too large to justify experimentation. Those three facts together remove freedom. That is what investors miss. They think a hold means the Fed still has patience. Sometimes a hold means patience. Sometimes a hold means paralysis. And paralysis is exactly what I believe this moment reveals. A central bank that believes it can still solve the problem behaves differently. It cuts or hikes with conviction. It speaks with a cleaner hierarchy of goals. It accepts the near-term pain attached to the long-term solution. What you are seeing now is not conviction. It is containment language from an institution standing inside contradictory arithmetic that matters. Because once the market understands that the Fed is trapped, the market stops honoring the old comforting assumption that the Fed can always fix what comes next. That assumption was one of the great supports under the entire post. Crisis financial world, take it away or even weaken it. And every asset priced off the expectation of clean rescue starts living in a harsher universe. That is the monetary cage. And the cage becomes even more severe when the pressure is not only economic but political. A central bank under open political pressure is no longer being judged only by inflation and employment. It is being judged by whether the public still believes it has the independence to inflict short-term pain when the arithmetic requires it. That is a much more dangerous test. Because once the market doubts the institution's ability to choose pain voluntarily, it starts pricing eventual debasement involuntarily. That is when gold wakes up. Now let me show you the second mechanism. I call it the oil lock. A lot of investors still treat oil as one input among many. That is too shallow. Oil is not just another cost in the wrong moment. It is a policy lock. The oil lock is what happens when energy prices rise high enough that inflation stops gliding down. But the broader economy is weak enough that the central bank cannot simply crush demand without risking a deeper contraction. That is the lock. Oil above the comfort zone turns inflation from a solved story back into a live threat. But if growth is already slowing, unemployment is already inching up, and manufacturing is already softening, then a hawkish response stops looking like discipline and starts looking like a detonation device. That is why this matters so much. An oil shock at full growth is one thing. An oil shock in a slowing economy with a debt, heavy sovereign balance sheet is something else entirely. That second version is where the trap becomes real. Because now inflation is not purely a demand story the Fed can cool with rates. It is a cost story feeding through fuel, freight, food, margins, expectations, and consumer psychology. And if the Fed tightens into that while the economy is already losing altitude, it may weaken demand without fully solving the cost pressure. That is the cruel part. The institution can still create pain and fail to create relief in the right proportion. That is a terrible position for a central bank to occupy. It means one of its old tools has become blunter at the exact moment. The consequences of using it have become larger. That is the oil lock. And once investors understand that the inflation threat is no longer cleanly rate sensitive, while the growth problem is becoming more rate sensitive, they stop believing that the next move from the Fed will restore the old order quickly. That is where phase shifts begin. Not when markets panic loudly, when policy loses elegance. That is the key. Now let me say something else that matters. People talk about inflation as though a number can tell the whole story. It cannot. An inflation print is a photograph. An oil shock is a process. The print tells you where the pressure was. The process tells you where the pressure is moving. That distinction matters because markets price the direction of the process faster than they price the comfort of the last photograph. Gold understands process. The average investor worships photographs. That is why the average investor arrives late. Now, let me show you the third mechanism. I call it the refinance wall. This is where the whole discussion stops being about monetary philosophy and becomes brutal arithmetic. The refinance wall is the mountain of debt that must be rolled at whatever rates the market demands, regardless of whether the timing is convenient, the economy is strong, or the central bank would prefer a different world. That is, the wall debt matures. Debt must be replaced. And when the debt stock is enormous, every change in funding costs becomes a fiscal event. That is where we are. If trillions of debt have to be refinanced, while rates remain materially above the levels at which much of the old debt was issued, the government's interest burden rises automatically. Not because Congress held a dramatic vote, because math rolled over. That is what the public never fully appreciates. The most dangerous developments in finance rarely arrive as speeches. They arrive as automatic consequences. You refinance old cheap debt into new expensive debt. The interest bill rises. The deficit widens. More debt must be issued. More debt requires more buyers. More buyers require more confidence or higher yields. That is the chain. And if the buyer base is already less enthusiastic than it once was, the wall gets harder. That is why a central bank trapped by oil and slowing growth is also trapped by debt. It is not merely deciding what inflation needs. It is deciding what the refinancing machine can bear. The old fantasy was that the Fed's inflation mandate sat in a clean room apart from the debt market. That fantasy is dead. A sovereign with a gigantic refinancing requirement turns every serious rate decision into a debt management decision, whether the institution enjoys that fact or not. That is the refinance wall. And once you understand it, you stop talking about rates like a tourist. A quarter point is no longer just a macro signal. At this scale, it is budget pressure, it is political pressure, it is bond market pressure, it is credibility pressure. That is why the institution sounds so careful. Not because it has clean options, because it has none. Now let me take this one step further. A lot of people still think the government can always solve a debt problem because it borrows in its own currency. Fine, that is exactly the issue. Borrowing in your own currency gives you room to postpone pain by changing where the pain lands. It does not remove the pain. You can suppress yields, you can create reserves, you can change names, you can alter the optics. But if the debt machine requires financing conditions that no longer match the inflation environment, honestly, the cost gets relocated into purchasing power, trust, and future policy credibility. That is the deeper truth. The refinance wall is not only about debt rolling over, it is about discovering whether the monetary system can remain clean while the debt system demands relief. That answer is getting uglier. Now let me show you the fourth mechanism. I call it the silent printing. This is one of the oldest central bank moves in history and one of the most misunderstood. The silent printing is what happens when the institution starts supplying liquidity through channels and language deliberately designed to avoid the emotional impact of calling it what it would have been called in an earlier cycle that matters. Because when a central bank changes the label but not the function, the label is not the story. The function is. If liquidity is being created to absorb funding stress, support reserve conditions, backstop treasury markets, or prevent a more visible funding rupture, then the market does not ultimately care what acronym the Fed uses. The market cares that the quantity of support is rising while the institution is still pretending the old vocabulary remains sufficient. That is the signal. You do not need the words quantitative easing to know when an institution is trying to ease pressure through balance sheet means you need only ask a harsher question. Is liquidity being supplied because the system is healthy or because it can no longer function smoothly without hidden assistance? That is the right question. And once you ask it, a lot of technical central bank behavior starts looking much more revealing. The reason this matters for gold is simple. Gold does not need a press release to understand monetary dilution. It only needs the direction of policy architecture. If the central bank is trapped enough that it must preserve appearances while still leaking support into the system, gold hears that more clearly than a million retail investors listening to a podium ever will. That is why I say gold prices what the Fed cannot say. The Fed talks in reputational language. Gold prices structural language, and structural language is more honest. Now let me add something else. Silent printing is not only about new money, it is about hierarchy. What is being protected first? Growth, employment, the bond market, the treasury market, the banking system, the political calendar. The answer matters. Because once the market realizes that the hierarchy now runs through funding stability and sovereign survivability before it runs cleanly through the inflation target, the old policy story is dead, whether the institution admits it or not. That is when phase 2 begins. Now let me show you the fifth mechanism. I call it the succession trap. This is where the entire system becomes even more unstable, because central bank uncertainty is not only about policy, it is about who will be trusted to deliver it. The succession trap is what happens when the market begins to price not only the current chair's lack of room, but the possibility that the next chair will enter office already shadowed by political expectations strong enough to distort the institution's perceived independence from day one. That is dangerous. A central bank can survive a bad economy more easily than it can survive the suspicion that its future decisions are no longer anchored to the mandate alone. That suspicion matters enormously because markets do not only price today's vote, they price the reaction function they believe will govern the votes that come later. If they conclude that the next chair will be under open pressure to ease regardless of inflation conditions, the market starts discounting that future debasement before the first cut occurs. That is how regime changes are priced, not only through action, through anticipated constraint. And once the anticipated constraint is visible enough, gold does not wait for confirmation. It reprices. That is what makes this moment so consequential. The market is no longer judging the Fed only as an institution with a difficult current meeting. It is judging the institution as one moving toward a leadership transition while already trapped in impossible arithmetic. That is a much more toxic combination than most people appreciate, because if the current chair cannot act freely and the next chair may not be believed to act freely even if he wants to, then the market begins to conclude something worse than simple policy error. It concludes that the institution itself is entering a period where the range of believable disciplined outcomes has narrowed dramatically. That is the succession trap. And in that environment, gold does not need certainty. It needs the probability that future money will be easier than future honesty. That probability is rising. Now let me show you the sixth mechanism. I call it the private credit fuse. This is where the next layer of the problem may come from, and it is one of the least understood parts of the whole landscape. The private credit fuse is what happens when years of cheap money behavior built up pools of leveraged assets, delayed markdowns, engineered valuations, and rolling refinancings that look manageable while rates are easy but become dangerous. Once growth softens, refinancing tightens, and exits disappear. That is the fuse. A lot of people still think systemic stress has to begin in banks because 2008 trained them to look there first. Number stress begins wherever opacity and leverage have been allowed to mature together under conditions of overconfidence. Sometimes that is a bank. Sometimes it is private credit. Sometimes it is private equity. Sometimes it is real estate held together by valuation marks that look cleaner than the cash flows really are. The point is not which label wins the contest. The point is that the Fed already knows the next accident will not emerge from a healthy, cleanly marked system. It will emerge from a pocket where truth has been delayed by structure. That is the private credit fuse. And this matters for the gold story because once the next accident arrives, the Fed will face an even crueler version of the current trap. Support the system and confirm the monetary debasement thesis. Refuse to support it and allow the damage to spread through funding channels. It knows can become contagious quickly. That is where phase 2 accelerates. Not when investors discover risk exists. When they discover the Fed, as only plausible response to the next credit accident, will strengthen the long-run case for hard assets, even if it temporarily tries to sound disciplined while doing it. That is the fuse. It may not be the first headline. It may be the next amplifier. And gold markets are exceptionally good at sniffing out amplifiers before the public reads the final report. Now let me show you the seventh mechanism. I call it the gold phase shift. This is where everything comes together. A lot of people think gold moves because people get scared. Sometimes that is the cartoon version. The real version is more precise. Gold moves hardest when the market realizes the central bank can no longer restore the old monetary order without creating a different crisis, just as large. That is the phase shift. Phase 1 of a gold bull market is usually institutional, quiet accumulation, reserve diversification, central banks buying without fanfare, smarter money moving before the public understands why. Phase 2 is different. Phase 2 starts when the wider market realizes the institution at the center of the system has lost its clean way out. That is when the move becomes faster, broader, and much more emotional. Because the buyer base changes, it is no longer only sovereign and strategic, it becomes private, defensive, speculative, and late. That is where the big repricing lives, not in the first calm accumulation, in the recognition. And I believe recognition is what this moment is delivering. Not because the Fed made a dramatic cut, not because Powell said anything theatrical, because the hold itself in this environment reveals enough. The hold says inflation is too alive to ignore. The growth data says weakness is too visible to dismiss. The debt market says refinancing pressure is too large to make rates morally clean. The political backdrop says future independence is too questionable to grant full confidence. The liquidity behavior says support is too necessary to call the system healthy. Put that together, and the market gets the answer. The Fed is not in control in the old sense. It is managing entrapment, that is gold-esque signal. That is phase 2. And once investors understand the phase shift correctly, they stop debating whether gold deserves the move and start asking how much of the move has already begun and how much remains. That is a different mindset, a more expensive one if you arrive late. Now, let me add silver because it belongs here. Silver is never just small gold. It is a more volatile creature because it sits in two worlds at once, monetary fear and industrial demand. That means it often looks weaker at exactly the wrong moment and stronger later than people emotionally thought possible. That is why phase 2 matters so much. If gold is repricing the central bank trap, silver often reprices it with leverage once the market believes the move is real enough to chase. That is a different asset experience. Same mother story, more instability, more late cycle excitement. That is why I tell people not to confuse silver's violence with thesis failure. Its violence is part of its role. Now let me show you the eighth mechanism. I call it the dollar exposure problem. This is where the entire discussion becomes personal. A lot of people hear gold talk and immediately think speculators. That is a mistake. The real issue is not whether gold enthusiasts get excited. The real issue is what happens to every portfolio built on the assumption that dollar-denominated assets can still be trusted as though the old policy regime remained intact. That is the exposure problem. If your retirement account is full of long-duration claims, if your bond allocation still assumes the old Fed put works the same way, if your cash still feels riskless because the statement number stays stable, if your equity exposures still depend on valuation multiples built for cleaner disinflationary conditions, then you are not neutral in this story. You are deeply in it. Because the question is no longer whether the dollar system survives abstractly. The question is whether the purchasing power, policy credibility, and rescue architecture beneath your savings remains strong enough to justify the way your portfolio is currently built. That is the exposure. And the honest answer is that most people are far more exposed than they think. They think they own diversified portfolios. Often they own clusters of dollar-dependent promises whose long-run safety rests on a central bank that no longer has room to move cleanly. That is not diversification. That is concentration in a weakening measuring stick. This is why I keep coming back to gold, not because it is magical, because it is one of the few major assets that does not require a central bank to solve its own trap gracefully. In order for the owner to maintain a claim on value, that matters a lot. And the closer the Fed gets to visible entrapment, the more valuable the distinction becomes. Now let me make the identity flip explicit. Most investors think their job today is to predict the next rate decision. That is too small. The real job is to understand whether the institution making the decision still has meaningful room to choose in a way that protects the purchasing power of the currency and the value of dollar claims without blowing up a different part of the system. That is the flip. Stop thinking like a Fed watcher, start thinking like a steward of capital. A Fed watcher asks, did they hold or cut? A steward asks, what does this reveal about the narrowing range of survivable options? A Fed watcher asks, what did Powell sound like? A steward asks, what did the arithmetic force him to hide? A Fed watcher wants the statement. A steward wants the trap. Those are different minds. You want the second one. Now, let me tell you the operating system I would use. First, stop reading a rate hold as neutral by default. Context decides whether a hold is calm or confession. Second, link oil, inflation, debt, and political pressure in one frame. They are one cage. Now, third, respect the fact that silent liquidity support matters even when the label used to describe it tries to make it sound harmless. Fourth, do not wait for a formal policy U-turn before treating the gold phase shift as real. Markets do not wait for official honesty. Fifth, understand that silver's volatility is not a separate story. It is the levered sibling of the same monetary trap. Sixth, re-evaluate every dollar's denominated promise you own through the lens of a central bank with shrinking room, not through the lens of the old rescue era. Seventh, stop waiting for all ambiguity to disappear. The best part of a phase shift is always over by then. That is the operating system. Not panic structure, not heroics positioning, not headlines, arithmetic. Now let me put the blade into this as cleanly as I can. The Fed's move did not matter because it surprised the market. It mattered because it revealed the institution's lack of clean exits. That is the signal. A trapped central bank holding rates into oil pressure, slowing growth, giant refinancing needs, political pressure, and hidden support operations is not stable. In the old sense, it is cornered, and cornered institutions make promises the market eventually stops believing at face value. That is when gold's language becomes clearer than the Fed's language. That is when phase 2 begins to matter more than phase 1. That is when money that looked comfortably parked in dollar-denominated form starts living in a more dangerous world than its owners realize. And if you remember nothing else from what I said, remember this. The most important thing the Fed revealed was not its decision. It was its prison. And once the market sees the bars clearly enough, the move in gold, silver, and every hard monetary hedge stops being a story about fear. It becomes a story about inevitability.